When you go out to raise money as an operator, you only get one shot. And so the vast majority of the time, your first 6 to 10 interactions with professional investors, you're A/B testing. And it's unnecessary with a system like this. So you can use this system, this initial stage of it, what I call the snapshot tier, where you're getting a snapshot of your company and you get to understand how a professional investor is going to view your firm. And it allows you to, we provide action items and very detailed, candid feedback about how an investor is going to view your company. And it gives you the opportunity to very clearly understand what you need to work on if you really want to maximize your chances of going out for capital.
What if your greatest professional leap wasn't forward, but inward? In today's episode, we sit down with Eric Vest, a rare blend of operator, technologist, and macro thinker, who shares the one-away moment that rewired how he saw business, capital, and the very architecture of value. From programming on a Radio Shack TND 3000 to advising billion-dollar boards, Eric's journey weaves the old with the new, transforming traditional industries through the quiet power of AI and conviction. But this isn't just another AI play. This is a deeper conversation about how empathy, strategy, and automation can coexist. How technology can be a tool for not just leverage, but respect. If you are building in chaos, investing in uncertainty, or simply trying to reimagine the system from within, you'll want to take notes. Let's get into it. Eric, welcome to the One Away Show.
How are you, Brian? It's good to see you again.
It's good to see you. This is the second recording, so expecting it to be, twice as good as the first. So, Eric, what is the one away moment that you want to share with us today?
I think it's that just the simple fact that I'm lucky enough to have sort of had an epiphany of that sort of tied all of the experience that I've had in my life together into what I'm doing now. And when I operated, 4 software companies, last company was an AI company before the pandemic, stepped away from operating in 2021 and started working for large private equity groups. And all of that work was great. It's accumulating a ton of experience and some specializations, and private equity wasn't really a good fit for me as an operator because I didn't want to be an operator. I really enjoyed investing and the strategic aspects of board work and sort of pulling big levers and pushing large buttons to create value over time. Did a lot of corporate M&A and that sort of stuff. But the private equity groups were all finance professionals. And so a lot of them were, frankly, sort of patronizing to operators, which was kind of bizarre to me because I kind of realized that the operators were providing the majority of the value. And so I wanted to do that work, but I didn't want to do it for a large firm. And so I was talking with a mentor of mine and he just gave me some great advice. He said, think about what it is that you've got a lot of experience in. What are you really good at? And where do your passions lie? And so I have a ton of experience in, starting, growing, selling companies in the technology space in one form or another, lots of life sciences, lots of manufacturing. And I found when I was mainly working in private equity, I'm good at growing and starting and growing companies, looking for opportunities. But what I really found was a superpower of mine was looking at a company and fairly quickly understanding how to increase the value of that company through the application of technology. And so for 20 some years, I was putting technology, enterprise software systems into industries that were not technology forward. And what I realized is that with my last company being an AI company and all of that experience, I thought, well, you know what, I think I want to do something with AI, but I don't want to do venture capital. And so instead of investing in AI companies, we'll invest in traditional companies that are preferably market leaders, healthy, growing, profitable, and where we can go in and create inflection through the application of tech. And you've got the opportunity to take a company that is growing at a decent CAGR, and if we did nothing to the company, we would make money, just by increasing top line and EBITDA and exiting on the same multiple. But one thing that I think is really interesting is by doing what we're doing, there's a very real multiple arbitrage opportunity where we can go in at, multiple X times EBITDA and then exit on X plus Y times EBITDA. Or perhaps even multiples of revenue. We'll never get to the point where we're exiting in my world where we were exiting on double-digit multiples of revenue, because that's pure software. But I think there's a tremendous amount of opportunity to, de-risk a company through technology, go through technology enablement, and create a tremendous amount of value and accretion for shareholders. So what I did was, after receiving that advice from my mentor, we tied all of that together, which is Y Capital. And so we do private equity investments, minority and majority positions in the lower middle market, focused on companies doing between 20 and 100 million in traditional industries where where there's a great opportunity to create impact through technology and through tech enablement and the acceptance of technology.
Yeah. Well, I love the kind of thesis and kind of where it's going, and how you're looking at these traditional companies, maybe that don't have a software layer yet, and saying, how do we really flip them on their head and, potentially trade at, a lot more EBITDA value, or even on a revenue basis to a degree. And using your experience, like you said, from, operating some of these past businesses and understanding kind of how these operators work and the value they drive, but really kind of bringing a kind of heightened edge and way of thinking, and someone who's actually been there and done that before, to the table. So super invaluable. Eric, I would love to understand, when you think about yourself, you said 4 software businesses. I think when I first met you, you said you had 3. Was it 3? You've exited 3 of those, or was it all 4? Yeah.
Yeah. The AI company unfortunately crashed and burned. I mean, we were in really good shape. That was started in 2016.
Yeah.
And we had a fully functioning neural network. We had 1,400 healthcare recruiters across the nation working for us as a side hustle to get the data set, and to, in effect, we were creating the equivalent of a FICO credit score, but for employment. And so, as fate would have it, we were focused on the healthcare industry. And we ran some successful pilots with major hospital networks and a home health company here in Philadelphia Metro. But as soon as COVID hit, the world shuts down. Our entire customer base is obviously inundated with dealing with a pandemic. And so the board voted to just shut it down, because no one knew how long the world was going to be closed. And so, while it was really unfortunate timing, it was a heck of an educational experience. So now I've kind of found that I kind of have a fairly unique skill set in terms of, a lot of entrepreneurial and operating experience, plus a really deep understanding of finance at both venture and private equity levels. And I also can be very hands-on with AI. And, kind of put that all together. It allows me to be a true value add investor.
Yeah, absolutely. And I again, one of the things I wanted to ask you, Eric, was, as you obviously have the finance side and the kind of math skills that you kind of need to operate a business, but there is a tech edge to you. And I want to understand, and for those listening, I think, yes, the fundamentals of business, speaking the language of business, I think being in the position you're in as a professional investor, it's going to be super important, especially as you think about driving, value back to your, LPs, and value to the operators you put money in.
Mm-hmm.
But tell me more about this technology side to you. Where do you maybe first start developing your, technical curiosity? What was it about software that kind of really spoke to you from a, early age? And I would just kind of love to dive into that. That'd be great.
Well, I think it all starts probably in like 1987 or 86 with a Tandy 3000 that my dad bought at Radio Shack. And it was, I've never really been into programming. And I kind of went through that process. I've always loved technology, about what technology could do. I tried to do a programming course in college, but it just bored me to tears. And it's like my college experience was fairly unique. I always knew that I wanted to do tech, but I had zero interest in being a computer science major. I didn't really know enough about business to even I couldn't wrap my head around what a business degree even was. And, but also like sort of being in the proximity, because I went to Penn, and having Wharton there and having so many friends who were in Wharton undergrad, had a big impact on me. And because I kind of fell off the turnip truck when I went to Philadelphia. I grew up in a farm town in central Ohio, and my dad was a steel worker. My mom was a stay-at-home mom. They were both Marines. They met at Camp Pendleton. So I grew up with a very blue collar background, and I wasn't privy to sort of a lot of aspects of the world. And so I liked business. I liked what that was all about. I liked the technology. So I just kind of put those two together, but I didn't study that stuff. I went to college thinking that I was going to be a double major in econ and Japanese, and they were both fine. But I'd always had a penchant for the Middle Ages. So I took a course on Chaucer, and my professor said, don't treat this like a trade school, study what you love, and have a great time, because you're never going to get 4 years again like this in your entire life. So I switched my degree to medieval literature and joined a fraternity. And, I wasn't a complete screw off. I worked hard, and got good grades, but I was already doing computer repair as a side hustle my senior year. As soon as I graduated, I was sort of installing point of sale systems for a buddy of mine who was franchising Boston Chickens and Subway sub shops down in Wilmington, worked for a professor, and then moved out to San Francisco and lucked upon the birth of the internet. And so that's when it really kind of hit. It hit home. I interviewed with some companies, and nothing was terribly attractive. So some friends of mine from Anderson Consulting said, Charles Schwab is starting to build out the first web trading system or stock trading system on the web. You should go talk to those guys. So I did. I did an interview, and the guy says, do you program HTML? And I'm like, of course I program in HTML. It's like, okay, you can start on Monday. And then, of course, I, sort of stop at Barnes and Noble on the way home and build up and buy a book on HTML programming and cram over the weekend. And that was the beginning of the first company. And we ended up being a fairly sizable Netscape partner, an Oracle partner, created Yahoo Store before Yahoo did. And Bloomingdale's used our first gen e-commerce system, and, rocking and rolling. But it's kind of funny, because I'm developing now an AI system that we're releasing next week. But you can do incredible things now, as long as you know architecture. Like if you understand the concept of APIs and data structures and arrays and sort of the management and movement and storage of data, some of these no code, not really no code, but low code tools can be incredibly powerful. So going back to the 90s, when I was programming primarily in C and some Java, and early, the very first version of JavaScript, that's primarily what we were doing. And it really wasn't my forte. I mean, I could do it, but it was made a lot more sense for me to hire people who were experts. Now, you don't really need that to a very large degree. You just primarily need system architects and product managers to be able to manage everything, oversee everything, And if you've got, I'm kind of blown away. Like over the past 3 months, I've been working on this system, but it's not programming, but it would be impossible to do if you weren't technical. So it's kind of fascinating. Y Capital itself is sort of a lot of things throughout my entire life and career coming full circle. Now it's very interesting because the technology has kind of come full circle where it is reliant to a degree, to a little enough degree that I am, you know, excited to jump up and actually be an engineer for the first time kind of ever. But it's a heck of a lot of fun. And it's just allowing me to leverage all of the knowledge that I've accumulated over the years of tech and the architecture of systems.
Yeah. Well, I mean, one, I think the story's fascinating going back to kind of school, Radio Shack, college, point of sale systems and Charles Schwab. And then, I mean, what a journey learning. But what you haven't shared is you definitely teased is this AI system that's rolling out next week. What have you built, Eric? What is, how are you taking all this experience and then connecting it to Y Capital in a way that, serves these entrepreneurs at this 20 million plus clip?
Sure. Well, importantly, what we're delivering, what we're developing isn't just for companies that sort of fit our investment criteria. I had, our whole investment thesis is investing in a company in a traditional industry where we can have a big impact through the application of AI and other advanced technologies. And so we started to raise, so we closed out our first investment and I started to raise a fund, $100 million fund to do on average $20 million investments. For anybody who's in the industry knows that the past 2 years have been brutal from a fundraising perspective, tons of friction, tons of headwinds, and it hasn't really gone away. We're obviously in a pretty chaotic time. Markets don't like disruption. And so there's a lot of money on the sidelines. You've still got a lot of firms with dry powder to make investments, but if you're looking for limited partners, it's a very difficult time. And it doesn't matter if you're Warburg or if you're us, it's going to be difficult to raise capital. So I decided, I'm like, okay, well, if we had to get the first $1.5 million committed, but I really didn't have a lot of interest in banging my head against a wall for the next 12 months to raise maybe the first 50 million so we could have an initial closing. So I thought, like, well, maybe I can use this time a little bit more productively. And because in the back of my head, I'm a solo GP. And I thought that in the back of my head that there had always been an opportunity for building out a team, but building out a team of AI personas instead of hiring analysts. If you take a look, this industry is very, very manual. The whole thing is based on hiring very smart young people to be your analysts, and they go through the ranks. And all of the diligence, all of the analysis, it's all done by people. And since you're really largely looking at the same thing, at the very least in preliminary due diligence, you're looking at numbers and determining metrics and figuring out exactly what, does this fit the sector, the firm know-how and experience, and does it match all of the performance criteria that we have set? And I thought to myself, this is a fantastic opportunity for AI. My opinion is that every job on the planet that's got analyst in the name is going to go away within the next 5 to 10 years. And so I thought, I'm already ahead of the curve. I'm going to explore and see if I can use AI to effectively create my first hires to manage our deal flow so that I can really pay close attention to the operators whom I wanted to, number one, I wanted to be able to communicate effectively with because I think that's, as a prior operator, it's one of the things that has always been really annoying about the industry is they'll say, if we're interested, let's say you email somebody a pitch deck you might get an email back. And if you get an email, it's like, well, we'll be in touch if we like what you've got. And that's it. And it's just sort of like, but the other side, the other thing that they say at the same time is, if you take a look at their website, every private equity venture group, they're all relationship driven. That's their primary emphasis. And I'm like, well, you guys really get off to a terrible foot, because everybody in the industry on both sides of the table, either the financiers and the operators, everybody knows that you're not relationship driven. And so you might be great once you're in the boardroom and you're supportive and communicative, but until you get to that place where the capital provider is saying, yeah, we want to get married, until that happens, the communication is typically pretty poor. So as an operator, I wanted to make sure that we were doing a good job of that and being respectful of all of the CEOs who are grinding to either reach a new level of performance so that they can get capital. And I thought to myself, why don't we start to build something out to do preliminary due diligence in a programmatic fashion, but you really fully leverage the AI. And I mean, obviously, I'm going to review everything before it goes out the door. But I spent 3 months training an AI system to really look at a company through the eyes of the appropriate stage of investor, and through the eyes of having a lot of sector experience. So what we've got now is we've got the ability for a CEO of any industry, of any stage, from pre-revenue to 500 million, ready to go public, and they can put their information into the system, and we provide them back for free. We provide back a very detailed 4 to 6 page report that is incredibly specific about the metrics that mean a lot, sort of where they stand. We developed this thing called a capital maturity spectrum, so a 0 to 100 scale. And we show them where they are, and we explain it all in detail, and it's all very, very relevant and nuanced based on the sector and the stage of the company. And includes, the CEO experience. I mean, everything goes into it. And so what that allows us to do is add value without having to charge anything to anybody. And then for those groups who want to do it on a much more consistent basis, eventually being able to connect with their QuickBooks system or their whatever accounting system that's got an open API, and they don't have to keep putting their information in. At that point, then we'll be in a great state to sort of provide virtual CFO services, to provide them with strategic financial feedback that, in my experience, is pretty rare, sub 100 million top line. And then what that allows us to do is we'll have our eyes on the entire spectrum, companies that are a good fit for us, and they've sort of met the criteria for receiving an investment, or at least engage. We'll do that for ourselves. But the majority of the stuff that I'm going to see, I know, is going to be sub 20 million revenue. So all of my friends and just people whom I don't know yet can set up profiles as capital partners and receive highly accurate deal flow. And so if it's just, again, this part hasn't been fleshed out just yet, but I have talked to a couple of firms who are very interested in receiving it frequently and having eyes on companies that might be a fit for them over the next 6 to 12 months, or perhaps even white labeling our system for use in their organizations. So again, it allows me to sort of be a good colleague within the industry. It allows me to add value for free of fees for a bunch of CEOs around the world. And it creates a lot of deal flow for us. And then ultimately monetizing this platform will allow us, because again, like, we're not a SaaS player, we're an investor. We're just eating our own dog food in terms of applying AI. And so it gives me the opportunity to generate revenue, and we'll use that revenue to decrease or potentially even eliminate your classic management fees for our limited partners, thereby decreasing friction to raise capital.
Super interesting. It's funny as you were talking, like before you. So one, I think it's brilliant. I'm not just telling you that because I like the idea, but as you were talking, I wrote down referrals, right? And then you started talking about it, and I wrote down what license. You talked about white labeling, and then and then you were talking about the data, and then I was thinking you could probably have industry reports, right? As like part of this. I mean, it's the whole investment platform, and then you take the cream of the crop that you like for yourself. I mean, that's pretty awesome.
Right. Yeah. Well, I'm pretty confident this is going to work out. This is something that I think has been a desperate need. And, one of the things that I've noticed is so I'm very involved in an organization called YPO. And one of the things that I've noticed, because I've been in international leadership and overseeing all of the entrepreneurs, like a huge cohort of total YPO, about 10,000 people in what's called the Entrepreneurship Network. And I've been involved in this. I was the chair for the past 2 years, and I've been on the board for what now, 8 years. And I saw that everyone desperately needs something like this, where they can, when you go out to raise money as an operator, you only get one shot. And so the vast majority of the time, your first 6 to 10 interactions with professional investors, you're A/B testing, and it's unnecessary with a system like this. So you can use this system, this initial stage of it, what I call the snapshot tier, where you're getting a snapshot of your company, and you get to understand how a professional investor is going to view your firm, and it allows you to. We provide action items and very detailed, candid feedback about how an investor is going to view your company. And it gives you the opportunity to very clearly understand what you need to work on if you really want to maximize your chances of going out for capital. So it's working with a gazillion entrepreneurs in YPO over the years. And just my own personal experience as well. It's something that is very desperately needed.
Yeah, absolutely. I mean, totally get it. I think you painted a nice picture. It's interesting. I think it's rare. I mean, obviously you've developed skills over the last 20, 30 years or whatever, you're a young guy, but, you have a blend of the operating skill sets with it seems like you also are able to have the vision for where it can go. It's reminding me of, have the visionary and the kind of the integrator kind of skill sets. It's the book Traction, where it's only 5% of people have both. Right. And it seems like, it's I can build, execute, operate. Oh, and I can kind of see the future and how to put the pieces together myself, which I think is pretty cool, especially in this age of AI. So anyways, that's what's coming to mind. Question for you. So I am a $25, $30 million company. I'm on your platform. I fill out my application, and the way you have your, AI set up was you get ding, 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 you got to talk to this company. What's a great profile for this kind of company? Maybe let's talk about industries. Use here up for disruption with technological innovation. Who are, the Y capital unicorns of the future?
Well, number one, there are a lot of companies, industrials and life sciences are the two big areas that I've got a lot of experience in. If you take a look at any technology adoption curve by Gartner, these industries are always the last ones to adopt tech. And it's one of the things that I've sort of learned over the years is the more your business is based on people, and and physical product as well. People is number one, physical product is number two. These industries typically don't adopt technology very quickly. And I think that if you're, the unicorns for us are companies that are, they've got healthy businesses, right? Profitable, healthy, growing. You don't have to worry about product market fit, which in the world of venture, early stage venture anyway, that's you're effectively funding a company hoping that they can reach product market fit. And that's just not my risk profile. I think that it's interesting in that, our first investment as a company in the construction industry, it's not known for being super technology forward. And so these guys make prefabricated facades, super, super fast growing. I think they're going to do probably around 50 million top line this year. Just a huge opportunity for, under normal circumstances, for these guys to be a great investment. And so when I took a look at the company, they had two aspects that I really liked. One is their asset light, which I loved because that meant that they could scale. And as a technology guy, I'm always looking for asset light's a really great thing. Whereas everyone in this industry is vertically integrated. If they're making facades, prefabricated facades like this company, Dextol, then they are, they've got their own, they buy a gigantic warehouse, they lease all of the machinery, they're, all of the stuff, all the supply chain, everything's showing up at their factories and they're building it themselves. Huge amounts of CapEx. And Dextol took the initial approach where they decided that, hey, we'll give up a few points of margin to not have to worry about CapEx, and we'll just line up a whole bunch of fabrication partners that can flex with the industry demand. Brilliant move. And then the other piece was that they had a small piece of software, still do, that they were using for internal processes to semi-automate the design of the facade. So they would import the 3D model from the architect, and then their software would expedite the process of identifying what's the most efficient way to clad the building and what's the most cost-effective way to clad the building. And they were shaving, it would take a process that was, engineers going back and forth. Typically, they were able to do this in a handful of days. And so it and in addition to that, since they control the supply chain, they could provide real-time pricing for the entire project to the architect. All of this stuff's unheard of. And so when I went to the board, because they've already got a VC on their board, and I said, you guys are a technology company, you don't even realize it. Like, we're never going to get rid of the physical product that's really the bread and butter of the company. But this is why we should go through a full-blown tech enablement and transform you from being a facade manufacturer to a technology leader in the construction industry. And it allows us to improve top line, open up new recurring revenue streams. And then from a shareholder perspective, it allows us to take advantage of that multiple arbitrage that I mentioned before. And so really it's a company that I feel super lucky because Dextol is smacking the bullseye of the kind of company that I was looking for. Traditional, low-tech industry. These guys were already they were already technology friendly. And so it was really just doubling down on the technology during the 5 to 7 year hold period.
Yeah.
Yeah.
Super interesting. I'm very well explained. And just to play back to you, I mean, you said this technology piece, right? And it sounds like a great business, traditional, like fit the profile. They were doing things with strategic maneuvers you liked, but the software piece, you saw an opportunity to truly build out a full scale kind of tech business. When you see that as a professional investor and you're like, oh, there's a sliver of technology, but if maximized or extrapolated out across XYZ functions or scaled into XYZ kind of other areas, like what do you do with that? Like, how do you take that sliver and then drive valuation or the multiple of, the value of the business 5, 10, 15x, from where it is today? Like, what's that process look like? How do you do it?
It's, number one, every company is unique. I think there are two aspects to it. One is sort of what everybody typically thinks about when they think about utilizing tech. It's operational efficiencies. Introducing robotics, automation, perhaps leveraging data to complete sort of a total quality management life cycle, feedback loop. That's where everyone's heads go, right? And most of that's EBITDA focused. Either you're decreasing headcount. If you go to an Amazon distribution center, I mean, there's hardly anybody who works in those things because it's all robotic. And so that's nothing new. Amazon really took that and put it on steroids, but that's what everyone's thought about in sort of real world businesses, how you utilize tech. But when you approach a company's efficiencies and how do we increase enterprise value from a technology lens, you start thinking about, okay, how can we monetize our data and how can we perhaps create software like or software focused revenue streams that are recurring, because that's what's really going to juice the returns. And oh, by the way, this is obviously going to feed into the marketing, because you have to visibly say, it's like, yeah, we want to tell the world that we're going to be a technology leader. And so your image in the marketplace evolves. And that's just through, PR and IR. But for instance, with Dextol, one of the things that we're looking at right now is, let's just say for arguments, these are not the numbers. This is all just hypothetical to be sensitive to the data. But let's say you got 20% EBITDA. And so on $1 million project, you've got $200,000 in EBITDA. And we say, okay, well, what we're going to do is instead of charging the customer $1 million for physical product, we'll take, say, 50,000, a chunk of our EBITDA, out of the product purchase category and move that over to a software licensing fee to decrease friction for the adoption of this software platform that we're rolling out, that provides them with sort of visibility into the supply chain, into the product, or into the project itself. They can see real-time shipping. It's really just providing a whole bunch of visibility to the developers and the general contractors and the architects, in addition to allowing people to transact, allowing new members to join the supply chain, allow new fabrication partners to sign up, that type of thing. And so instead of charging architects or developers or GCs a fee to access the platform, we simply recategorize some of the existing revenue that's coming in, allows them to take basically whatever, in this case, let's say $50,000 worth, it'd probably be more than that, but $50,000 off of their OpEx or off of their CapEx and moves it over to OpEx. So now they're able to deduct that cost immediately instead of having to depreciate it over time on an amortization schedule for physical product. And it gives us now the same number of revenue, but that 50 grand that just went over to OpEx for a software subscription is recurring over time. That's valued at 4x the value as it was when it was categorized as a panel that's going up on a building. And so a lot of times I think that we're going to find the value that we can really generate is available to us simply because we're taking a look at real world, old school industries through a different lens. And that's one of being a technology company.
Yeah. Interesting. So it's like financial engineering in a way, like to a degree, where you're kind of looking at, the back end and then saying, okay, well, let's reallocate 50K in costs to something that's going to be 4x the value on $1 million project. But that sets up a recurring software ecosystem where, 6 years down the road, when you do that 10 times over, it's a nice chunk. Interesting. Super, super interesting. I'm glad to get the inside the Eric Vest playbook here. This is nice. Very cool. If you're a founder looking to grow without raising capital or giving up control, Relent is built for you. Founded by entrepreneurs who've scaled without outside funding, Relent helps companies find and retain talent, lower operational costs, and reinvest in growth. We've hired nearly 10 team members through Relent and streamlined our entire cost structure, freeing up capital to put toward what matters most. Even small teams can set up offshore operations quickly, compliantly, and without heavy infrastructure. With deep expertise in the India-US corridor, Relent combines cultural fluency with operational rigor and guides everything from team design to long-term scaling. Grow on your terms and start with Relent. To learn more, visit relent.team/arcbound. Eric, you're someone who's clearly one to never stop growing, clearly innovating, investing in your own intellectual pursuits. As you take on this new journey with Y Capital, a mixture of all the past, present, and then into the future, like what do you see for yourself and like what you need to evolve into the most, like in the future version of you, maybe to achieve some of the things that you see are possible that maybe that you haven't developed into yet?
You mean on a personal level?
I mean, either way. I mean, like the professional things that like you see in front of you that like, it's like we see these future versions of ourselves personally,
Mhm.
professionally, but we sometimes know that maybe get there, there's certain changes that we need to learn, or things we need to people we need to meet, or to make that possible. So I mean, feel free to answer it from any dimension, but I'm asking from the context of 3 to 5 years from now, you see Y Capital, you know, as an investment platform, and these like what are the things that you see in the future that you're going to need to hurdle, overcome, face to ultimately get there?
Well, I think that I've always been, and this is maybe just because I sort of cut my teeth in the 90s in the technology industry. I've always subscribed to the belief that if you're not failing, you're not trying. And pair that with one of the reasons why I love YPO so much is the motto is lifelong learning. And I see my professional pursuits as sort of a vehicle for doing that. On the personal side, yeah, I mean, I could, try to get my handicap lower, but it's like, that's certainly challenging, and I'm certainly learning stuff, but it's not intellectual, and intellectual growth and discovery is something that's always been important to me for myself. And one of the things that I think is kind of interesting as well, that technology has always been, it's probably one of the reasons why I've always been attracted to it, is it moves fast. And it's, if you think about innovation in general over the past really kind of forever, whether you're talking about creating a stone tool or you're talking about artificial intelligence, at some point that innovation was through some form of technology. And so I've learned about myself over the years that I'm very much a macro thinker. Um, I was just driving back from DC with my daughter yesterday, and we were always talking to her about her what she's learned in history this year in class. She's in the eighth grade, or sorry, she's a sophomore. She'll be rising junior. My other one's in the eighth grade, and we were talking about this incredible book that I just read called The Fourth Turning, and then the subsequent book was The Fourth Turning is Here. And it provides sort of an ancient framework of the evolution of a society in roughly 100-year-long cycles. And it's just bringing together sort of philosophy, anthropology, the movements of people, the evolution of societies and technologies, and what makes some excel, like the United States, and what makes others lag. I find that sort of stuff absolutely fascinating. So I kind of find myself. You kind of touched on it before. I can go really deep into the mechanics of actually building out an AI application. But I don't think I'd be able to do that very successfully if I weren't able to have a macro level perspective on whatever we're talking about, the evolution of the capital markets. Where do the opportunities for disruption exist? What is it that CEOs have been lacking forever? And what does this new technology allow for the creation of value? Yeah, all of that stuff. I just think it kind of comes down to, for me personally, I have to continually be intellectually challenged, because I think at the end of the day, that's kind of what gets me out of bed. And Y Capital being an investment platform that has AI at its core, both from a value creation and an operations perspective, that is an endeavor that I'd happily sign up for.
Love it. Love it. I mean, what I've heard you said was I like having depth, but it wouldn't be possible without range or a macro view of how I learn things to bring into the depth of my intellectual pursuits. So, very cool. I have one more question for you, and we'll send you on your way. Um, you're giving your knowledge of history and some of the things you've shared with me and the way you think about the world, right? At a global level, we have, you know, the war in the Middle East in a sense right now with the recent Iran, we have Israel, we have Ukraine and Russia. There's so much happening right now. We have the instability in the markets, right? Like, how are you thinking about this as a professional investor, and how should operators be thinking about this in, let's just say, the next 2 to 3 years?
When you take a look at periods like this, where you're going through a lot of it's a societal, we're kind of past the upheaval and at a climax. I love, it's one of the reasons why I love the whole framework that that the fourth turning provided. Is you've got spring, summer, fall, and winter, and societies as a whole go through that same cycle just like humans do in their lifespans. And just through, a lot of times we'll look at it in terms of business cycles. Sometimes, most of the time, it's just a sine curve, ups and downs. You can't really look at the market anymore because it's really artificially inflated due to 401k injections on a daily basis. But when you take a look at the sort of macro geopolitical things going on, and also the political climate in the United States, everyone can kind of viscerally fear or feel that the amount of chaos and the amount of disruption it's increasing, and it's been increasing for quite some time. And I think that we've got another 5 to 8 years more of this increasing. And, I think that traditionally at the end of this type of a period, you've got a hot war, the American Revolution, Civil War, the Great Depression, and the World Wars, and the Great Recession. Like, all of those things sort of started these winter periods. And it's uncanny how accurately they fall between 85 and 100 years between each other. And so I'm sort of an adherent, because a lot of these guys researched the heck out of it, and a lot of it makes a lot of sense. And so on a global basis, we're going to be experiencing, I think, at least 3 more years of increasing amounts of upheaval and conflict. And from a capital markets perspective, you know what that means? No one's giving their money out to anybody for investments anytime soon. That's the biggest challenge. I think that you've got certain sectors that are able to weather these times. But, I think by and large, the market's just like continuity and stability. And we're going to be in a period of increasing instability and discontinuity. So I think that everyone should be sort of buckled up, and companies should be preserving cash. I think that if you can, I think there's an interesting dynamic, because most funds are closed-end funds. So there are groups out there that have dry powder to invest in solid companies that they think can withstand the next 3 to 5 years. But looking for LPs is going to be challenging. And so, again, that kind of comes back to one of the reasons why we're taking the approach that we're trying to take: generate SaaS revenue to offset management fees to decrease friction for our LPs to sign up with us. And we're really betting the house on the fact, or on the thesis, that AI over the next 10, 20 years is really going to be the primary catalyst for change and value creation, certainly in North America, but and across the globe on a more generalized basis.
What an answer. Super interesting. I was on a walk last year with this guy in San Francisco, and he was literally telling me about this book. I forgot I was because he was telling me every 100 years, everything you were saying. I was like, I've heard about this book. I wrote it down. Like, okay, about time. When you hear something for the second or third time that's a book, there's probably a reason. So, Eric, this has been. I mean, the first interview was okay. This was top notch. I mean, you get better and better. So it's a fine wine. Where can people find you?
Well, we can just delete this one and do it
No,
a third
no,
time.
no, no. We got to preserve this one, like you preserve cash. This is a good one to hold on to. Where can we find you?
LinkedIn, obviously. The website is ycapital.pe. And again, today we're going to be announcing the Dexdal deal, and then later this week we're going to be announcing the sort of first stage of the capital intelligence platform. So keep your eyes peeled on LinkedIn and some of the other business news channels, and look forward to interacting with anybody who wants to go check us out.
Awesome. Thanks so much.
Thanks, Brian.
Eric Vest doesn't just talk about the future, he builds bridges to it. Whether it's transforming construction firms into SaaS engines or using AI to rethink the role of capital itself, Eric reminds us that innovation isn't always flashy. Sometimes it's subtle, strategic, and rooted in deep empathy for the operator. And maybe that's the real takeaway, that the next era of capital won't be about cold math, but warm intelligence, built by those who've sat on both sides of the table. Thank you for listening. If this episode made you rethink how technology and humanity intersect in the business world, share it with someone building in the dark. Until next time, keep asking better questions, and don't wait for the future to show up. Go build it.